Assalamu alaikum. This is lecture 37 of Advanced Cost and Management Accounting. We are discussing quantitative model for inventory control. Inventory control is important because it is perhaps the single most biggest item on the balance sheet of many companies. So inventory is a large figure in the balance sheet. So it is going to have a big cost, and in order to maintain and in order to control this cost, whatever is done to minimize and efficiently control the cost, it will have an impact on the organization and the company, as it is a large amount. So any small adjustments that are required to be made to bring about cost savings, to bring about cost efficiencies, and to bring about effectiveness of managing inventory, it is going to have a significant impact in terms of cost for the organization. We have said that for the quantitative model, we have looked at inventory and we have tried to identify the costs that relate to inventory. In trying to control inventory, we are trying to control the level of inventory, the quantity of inventory. We are trying to control that. And therefore, the costs that we have said are the relevant costs are those costs that will vary with the variation in the quantities of inventory. So if inventory is reduced, those costs which will also be reduced are relevant. When inventory increases, those costs that also increase are going to be relevant for our model, because we can only take decisions to affect costs which are variable costs, which vary with the level of inventory. So varying costs are going to be examined, and we are going to try to identify ways and means of trying to control this inventory and control the inventory cost. Relevant costs are therefore those costs which are going to affect the decision making. We have discussed relevant costs earlier in earlier sessions, and we will recall that relevant costs are those costs that will change and therefore impact some decisions. Now for inventory, we have said that ordering of the inventory is an important part. When you make an order for inventory, what should be the quantity of that order? And we talked about the economic order quantity. So we are saying that it is important to decide and arrive at what quantity should each order be. And we are going to use the economic quantitative model for that. And that is where we are going to try to highlight the usefulness of this economic order quantity model. I want to give an example of economic order quantity in our everyday use and everyday life. One example, and the way to think about economic order quantity can be that we take the example of a car or a motorbike, whatever vehicle we are using, and every time we want to fill it with petrol or CNG, whatever. Now, there is a size of the tank, and the size of the tank could be quite large. But it is not necessary that every time everybody goes to the petrol station that they completely fill their tank. So it is like thinking of that how much of the tank should be filled. This will depend, of course, on how much you are going to use, how frequently you want to come and have the fuel refueling done. So these are the factors that are going to affect the quantity of your fueling of the car or the motorbike. This is an example of how the economic and the quantity of the filling, each filling is going to be implemented. So somebody will fill the car to the top every time. Somebody will use half of the tank, somebody will use less. And this will depend upon their various circumstances and their various priorities, and of course how they want to manage the cost and the running of the vehicle. One other example is that you want to draw cash from the bank. Now, either people go to the bank, write out a check and draw some money from the bank, or they will go to the ATM, use their ATM card, punch in their numbers and draw the required cash. How much cash should they use every time they go to the bank? How much cash should they withdraw? This is again going to vary according to the needs of the individual and how frequently they want to go and do this withdrawal of cash or cash amounts. So you can think of the economic order quantity in similar ways, that every time you want to buy material and bring it into your store, how much should you buy? And we are going to discuss a model that is going to minimize this cost and make the most efficient order quantity to purchase every time. So that is what is the economic order quantity dealing with. Relevant holding costs: warehousing and storage, salary of storekeeper, depreciation of equipment, fixed rental of buildings and equipment are irrelevant. There are two main types of costs that we have discussed in arriving at the economic order quantity. And those two major types of cost of inventory which are relevant, which means they vary, are one, the holding cost, and secondly, the ordering cost. So these are the two costs, and we are going to say that the part which varies in these two costs, the holding and the ordering cost, that part is what is relevant to our decision making. And we've just seen that if there is a warehouse and there is a storekeeper and the salary is paid every month, this is a fixed cost. So this cost is not going to change if the inventory level falls or increases. This minimum cost will remain the same. Similarly, the depreciation of the equipment in the warehouse, this is also a holding cost. The warehouse is a holding cost. The cost of warehousing and storage and keeping, that is all part of the holding cost. So the depreciation of all the equipment in the warehouse, that is going to be a fixed cost. That depreciation is not going to change every time the inventory level either goes down or up. So that costs such as these, we are saying, are costs which are irrelevant. If we are paying a rental for the warehouse, again, the rental is a fixed cost. So the rental, the depreciation, or the storekeeper's salary, all these costs are examples of fixed costs. And those costs which are fixed are not relevant to our computation of the economic order quantity. And these are holding costs which are irrelevant. Therefore, the relevant costs will be those which are going to change and vary with the level of inventory. If space can be rented out, it should be included as opportunity cost. Opportunity cost is the alternative cost, the alternative foregone. So if you have a warehouse, we are saying that warehouse rental is normally a fixed cost. But if you own the warehouse and the inventory level goes down, you have excess space available. If you are able to rent that excess space, and the provision exists and the possibility exists, then that rental income is the opportunity cost of using that warehouse space. So then that part of the warehouse holding cost, warehouse rental cost, that part of the holding cost can be relevant. If it can be rented out, then it is the opportunity cost, and the opportunity cost should be included as relevant holding cost. Insurance cost should be included only when premiums are charged on fluctuating levels of stock. Fixed annual insurance cost is not a relevant holding cost. Similar principle apply to the insurance cost. The insurance can be of two types. If you have an insurance which is on such risks that are fixed and you have to pay an annual premium regardless of the level of inventory, that is fixed insurance cost, that will not be relevant. But if you are insuring the stock itself, this means that each time the stock inventory level goes down, the insurance premium will go down. It will be based on the level of inventory. And each time the inventory level goes up, the insurance cost will also go up, the premium will be increased. This variable type of insurance cost is relevant cost for our computation. It is a part of the relevant holding cost. The opportunity cost of holding stocks is reflected in the required return from investment. The investment in the stock itself is also a cost, and the way to measure that in terms of holding cost and ordering cost and the economic order quantity is to measure the opportunity cost. So the opportunity cost of holding stock, the amount of stock, there is some amount of investment in the stock. The cost of stock is the investment, don't forget, in the stock. So the opportunity cost of using that money for stocks is the cost also relevant for holding. So the opportunity cost is given by the available rate of return on investment. If you didn't invest this money in stocks, if you were able to invest it in some other asset and you were able to generate some return, then the rate of return will represent the opportunity cost of holding the inventory. So that will be the relevant inventory holding cost. Relevant ordering costs. Ordering costs consist of preparing a purchase order, receiving deliveries, and paying invoices. The other major cost for inventory, we said, is the ordering cost. Now, ordering cost consists of things such as initiating a purchase order. So there will be somebody who will be writing out a document. There'll have to be some quotations obtained from the market. Some people will be in a department, purchase department. All that cost is ordering cost. So the cost of ordering is how we are going to look at. Now, in order to see the relevant ordering costs, we are going to look at what is the cost of the purchase order, what is the cost of receiving the material, and the cost of writing out the checks and paying invoices. All this is cost involved in accommodating people who are stationed and they are receiving invoices in the system and the computerization, and people are having to write out checks and sign checks and make payments to the suppliers. So this part is the ordering cost. This is a part of the relevant ordering cost, because the more the number of orders, the more will be the cost such as this. To estimate variable cost of ordering, the number of orders placed is used. We have mentioned that the cost of ordering will include people who are writing out the purchase orders, the receiving and handling of the material, plus the payment, etc. of the invoices. Now, of course, you have to make some kind of an estimate, because the variation in the number of orders is not going to exactly correspond with variation in all the ordering costs. So usually, in a way of trying to estimate the cost of ordering, a cost per order is calculated. So you have an estimate of total orders and you have an estimate of total cost, and so you can arrive at what would be the cost per individual order. So in arriving at the variable cost of order, each cost of order is estimated and you have a cost per order. This helps you in your calculation of the model of acquiring and using the model for the ordering cost, estimate of the variable ordering cost. The cost of acquiring stock is not relevant as it remains unchanged irrespective of the order size or stock level, except where quantity discounts are available. This is discussed later. We are not going to include the cost of the stock itself because we are concerned with the order quantity. Now, whatever the quantity of the order, the total cost of acquiring inventory in a year is going to remain the same. So the purchase price is going to remain the same. Therefore, we are saying the purchase price of the stock is going to be irrelevant. It is going to change where we have some quantity discounts, so that if our order size is larger, then there is some discount in the pricing and we get a lower cost. This quantity discount part we are going to discuss in a little bit later on in this session. So therefore, purchase price of the stock we are going to regard as irrelevant. Ordering and holding costs will change in relation to the order size. These will be relevant for decision-making models. We are concerned in trying to minimize the cost of inventory and to minimize the cost of ordering and holding. These are two costs which in fact are in a way opposite. As the inventory size increases, the holding cost increases because there is more need to hold a greater amount of inventory. So as inventory increases, the holding cost is going to increase. But the ordering cost might reduce because in each single order, you might have a greater quantity. So the number of orders might reduce and therefore the ordering cost might reduce. So ordering cost is going to reduce, holding cost is going to increase with the increase in inventory. We are trying to arrive at a condition where both these costs are minimized, and that is going to give us the economic order quantity. Economic order quantity. If more units are ordered at one time, fewer orders will be required per year. This will mean reduction in ordering cost. However, when fewer orders are placed, larger average stocks must be maintained. This leads to an increase in holding cost. The economic quantity is going to balance the two costs and try to arrive at the minimum cost, lowest cost order size. Again, we are concerned with the size of each order, because the size of each order is going to affect both the costs, the ordering cost and the holding cost. So our model is going to consider the two costs, and it is going to try to arrive at a position where both the costs are at a minimum. That will be the best order size. We have said that these are costs which are opposite in direction to one another. In other words, inventory goes up, holding cost goes up, ordering cost goes down. Inventory goes down, more this inventory holding balance we are talking about. The amount of inventory that we hold. Don't forget, this has to be related to the total amount of inventory that has to be consumed in a year. Now that is going to remain the same. Total amount of inventory consumed in the year is going to be the same. The amount of inventory that you will hold will depend on the size of each order and how often you make those orders. So we are now looking at the size of the order. That is going to determine the amount of inventory held, and therefore it is going to determine the holding and the ordering cost. We are going to work out a situation how to minimize the holding and the ordering cost. The optimum order size is one where the total amount of ordering and holding costs are minimized. This is known as the economic order quantity. So we are going to devise a model, and our model is going to show that how we can minimize the total cost of holding inventory. The total cost basically comprising of the holding cost and the ordering cost. So this is our economic order quantity model. The economic order quantity is therefore to be understood as the quantity of the order every time you place an order. And why we call it the economic order quantity? It is going to be the most economical quantity for each order. So economic order quantity is going to be the order quantity which is going to minimize the holding and the ordering cost. Example of the EOQ. A company purchases a raw material from an outside supplier at a cost of ₹9 per unit. The total annual demand for this product is 40,000 units, and the following additional information is available. Let us try to examine now, by use of an example, how this economic order quantity is going to work. We'll take it step by step, and we'll first look at the very basic workings of how the order quantity variations are going to reflect changes in cost. So in our example, we are given that the demand for annual requirement is 40,000 units. The cost is ₹9 per unit. So from an outside supplier, we are going to pay ₹9 per unit, and we are going to need 40,000 units of this material throughout the year. A required annual return on investment in stocks, 10% of ₹9 is 0.9. Other holding cost per unit is 0.1. Holding cost per unit is ₹1 per unit. Cost per purchase order is ₹2 per unit. Determine optimal order quantity. Holding cost has been broken down into two parts. One part is the opportunity cost of investments in stock, and there a rate of 10% has been used. The cost per unit is ₹9, so 10% of that, 0.9, is the opportunity cost of investment in inventory, and we are told that other holding cost is 0.1 per unit. So we get to a total of ₹1 per unit holding cost. And then we are told that the cost per order is ₹2 per order. So ordering cost is ₹2 per unit, ordering cost is ₹2 per unit, and holding cost is ₹1 per unit. These are the two costs. What should be the size of the order to minimize these costs when we need 40,000 units in a year? We are now going to examine the cost, the total cost of inventory by using different order sizes. So we have used the example where order quantity is 200, that's the first column, then 400 order quantity, 600, and 800. If these were to be the size of each order, what would be our costs? Let's examine. Average units in stock would be, for 200, they would be 100. For 400, 200. For 600, 300. For 800, 400. The order size we are using ranges from 200 to 800. 200, 400, 600, and 800. What is the size of average stock? Assuming a constant rate of usage of stock, if the order is for 200, every time we make an order, 200 units arrive, then we start to consume them, and so the level of stock comes down as over time, and then when it gets to 0, we order 200 again, so we have the level of inventory level of 200. So the average is going to be between 0 and 200, that's 100. So midpoint basically we are using as the average. So in all these four cases, for 200 the midpoint is 100, for 400 the midpoint is 200, and so forth. So the average stock has been taken as the midpoint. Number of purchase orders, for 200 it's 200, for 400 it's 100, for 600 67, and for 800 50. So how do we arrive at the number of purchase orders? We are going to take the total quantity required in the year, and we are going to divide that by the size of the order quantity. That is going to give us the number of orders. So 40,000 divided by 200 gives 200. This is the number of orders, purchase orders for order quantity of 200. Similarly, if the quantity is 800 and we need 40,000, so 40,000 divided by 800 is 50, and so the number of purchase orders would be 50. So that's how we calculate the number of orders. Take the total quantity required, divide that by the order quantity. That gives the number of purchase orders. Annual holding cost is rupees 100, 200, 300, 400. Now we are given that the annual holding cost is rupee 1 per unit. In our question, we were given two parts of the holding cost, 0.9 and 0.1, coming up to rupee 1 per unit. So if 1 per unit is the holding cost, then we multiply that by the average cost, average stock held, that we've just calculated. So multiply the average stock held by rupee 1 per unit, you will arrive at the annual holding cost, and that is rupees 100, 200, 300, and 400 for our four different order quantity sizes. Annual ordering cost. The annual ordering cost is going to be the number of purchase orders multiplied by the cost per order that we have calculated, that we have been given rather. So we have been given that the cost per order is rupees 2. If the purchase orders are 200, the ordering cost will be 400, and so on and so forth, where for 800 units, the number of purchase orders is 50, our ordering cost is going to be rupees 100. So we have tabulated these all four different types of costs for the four different order sizes, and we come to the relevant cost, the total relevant cost for all the order sizes. The total relevant cost for 200 size is 500, for the 400 order size it's 400, for 600 it's 434, and for 800 it is 500. So we can see that the minimum cost is rupees 400, and that occurs when the order quantity size is 400. By taking a simple example and using the different order sizes, we have tried to illustrate that there is a change in the total cost. And the total relevant cost is going to change if we change the order size. So we used four different order sizes, 200, 400, 600, and 800. And we found that the lowest total cost is for the order size of 400. So therefore, our EOQ simply on the basis of an analysis of different order sizes is going to be 400. While the holding cost rises with the increase in order size, the ordering cost is going to reduce with the increasing order size. So the total cost is going to be somewhere in between, and it is going to fall for a little while, and then it is going to increase after that. So the minimum point is the point at which we are going to say this is the economic order quantity. That is going to be the order quantity which gives the minimum total cost. That's what we are trying to do. We are trying to minimize our total cost and arrive at a point for ordering at the point at which it is going to be minimum. The EOQ using the formula method. Economic order quantity can be found by applying a formula. The formula incorporates basic relationship between holding and ordering costs and order quantities. After having seen the graph and a sort of tabulation method, we are now going to discuss the formula method. So the entire thing can be it can be put into a formula, and the formula is going to look at the relationships between the order quantity sizes and the holding and the ordering costs. These three factors put together and using a formula that we are just going to see, that is going to give us a formula for calculating the economic order quantity every time we need to. Number of orders for a period is the total demand for the period D divided by the quantity in each order Q. We have seen this also in our workings in the last example. We are going to call the total amount of requirement or demand for the year as D. The quantity for the year will be denoted by the letter D, and the quantity of the order is going to be denoted by the letter Q. So if we divide D by Q, we come to the number of orders. The total quantity demanded divided by the quantity of each order. This is going to give us the number of orders required. Ordering cost is obtained by multiplying the number of orders for a period by the cost per order O. The cost per order we are going to denote by the letter O. So we are saying that in arriving at the ordering cost, we have the estimate of the cost per order. Once we have the estimate of the cost per order, we can use that, multiply it by the number of orders to arrive at the ordering cost. Hence, ordering cost is given by demand for the period over quantity in each order multiplied by the cost per order, DO over Q. Holding costs will be the average stock, Q over 2, multiplied by holding cost per unit, H. We have seen that the average stock held can be estimated by using the midpoint. So the total quantity of the order divided by 2, that is going to give us the average stock held. And if we have calculated and denote the holding cost per unit as H, then multiplying H by the Q over 2, which is the average stock, will give us the holding stock. Quantity of order over 2 multiplied by holding cost per unit is equal to QH over 2. So the holding cost will be given by Q over 2 into H, average stock into the holding cost per unit. So now we have given alphabets and letters to denote the various types of costs. So we have said that DO over Q is the ordering cost and QH over 2 is the holding cost. Hence the total cost for any order quantity TC is going to be DO over Q, the ordering cost, plus QH over 2, which is the holding cost. Ordering cost plus the holding cost. We can determine the minimum with respect to Q as Q is equal to the under root 2 DO over H. Q is the quantity, D is the demand for the period, O is the ordering cost per order, and H is the holding cost per unit. The exact calculation of the formula is done using a method of differentiation, and that you will probably cover in some mathematics course. You don't actually need the working and the differentiation part for this course. For this course, we will just take the formula as we are given as the derivation. So we have said that the total cost, therefore, is going to be the ordering cost and the holding cost. Ordering cost is given by DO over Q, and holding cost is given by QH over 2. These two put together give you the total cost. And we differentiate with respect to Q, which is the quantity, and we arrive at the formula which gives us the economic order quantity. The formula is the under root 2 DO over H. That provides the formula for calculating the economic order quantity. Assumptions of economic order quantity formula. Holding cost per unit will be constant. Additional storekeepers might be higher as the stock increase beyond a certain level. So we have just discussed a formula for the calculation of the economic order quantity. Now, formula is going to be based on certain assumptions, and it is not, of course, in practice necessary that the assumptions will hold true. But having said that, there is still a lot of usefulness for the formulas that we use. There is a lot of practical advantage to be had, even though there are estimates and there are assumptions. In the case of inventory, we are saying that first of all, we should only be looking at the variable cost. Now, the variable cost of inventory is also quite hard to establish, because we talked about the storekeeper. Now, if we are saying that the salary of the storekeeper is going to be part of fixed cost and not the variable cost, well, that will not necessarily be true for all volumes of stock and for all quantities of the order size. As the order size increases, we said the holding of inventory is going to increase. So it might be that beyond a certain amount of inventory and beyond a certain amount of capacity of the warehouse, you need to add additional storekeeper. So then that cost is going to change. So this be what can sometimes be described as a step cost, that it is fixed for a certain level of activity, but beyond that it will be increased immediately to the next level, and that will remain constant for another level of activity. So this is one assumption that we have to take in our EOQ formula. We are looking at basically only the variable expenses, and if we exclude the cost of the storekeeper, then it might be that the storekeeper needs to be added. The cost of the storekeeper will add when the quantity of holding and the quantity of orders goes beyond a certain level and a certain point. Average stock balance is equal to 1/2 of the order quantity, i.e., constant amount of stock is consumed per day. The next assumption we are taking is that the consumption of stock is going to be constant. We are using, our formula is using average stock, and it is using therefore holding cost per unit and multiplying that by the average stock. The way we are calculating average stock is using the midpoint. The midpoint is only relevant and is only true if there is constant usage of stock. In other words, the amount of stock needed and used and consumed is constant each day. Practically, this also doesn't happen. Very often, due to various circumstances, that includes availability of material. It can be due to capacity of machines, requirement of different types of product. It can be due to some machine breakdowns or even some kind of other shutdowns due to labor, etc. So there are many other factors that might influence the consumption of stock on a daily basis. And it is unlikely that it is going to be a straight line and exact consumption of stock on a daily basis. So this is going to give a different answer if we change our average stock. If there is a more complex system, one can perhaps use a compounded average basis, but those are further complications, and those are, in any case, the estimates. Weighted averages are used. Weighted averages can provide a slightly more accurate averaging figure. The point we are making is that this is an estimation. The formula is giving you an estimate, and it is not going to be an exact position that the company will be able to adopt due to the various practical difficulties and variations that arise in actual performance. So this assumption of consuming stock or constantly on a daily basis, it is an assumption for the formula, it is an estimation, not necessarily true in real life. So the formula is again going to give you an estimate of the order quantity, which is going to minimize the cost, but in actual fact and in practical terms, it might not always be true. Despite the approximations in the data, the calculation of EOQ is still likely to be useful. There are assumptions. Every time you use these kind of mathematical formulas, you have to use some assumptions, and they give you some approximating figures. So the answer that we will get from using the EOQ model for the quantity to be used for each order, is it going to be useful or not because of these assumptions? And it will turn out that to have some indication based on certain assumptions, you can still find usefulness in this EOQ. To have some idea of what is approximately the order size that is going to minimize the cost. We have said that inventory is an important asset. It is important due to its size, significant size. The size is such that it is perhaps the largest asset that most companies own. And so finding an approximation to provide a minimum cost order size is still going to be useful. Without this, the order size that might be used might be totally haphazard. It might not have a basis with proper consideration of cost, and the organization might end up adding cost to the inventory, which is already expensive, and that cost would be wastage and additional cost, undue and unnecessary cost. So in order to minimize the wastages, minimize the cost increases because of uncalculated order sizes and holding of inventory and size of inventory, in current environment of competitive global competition where costs have become very important. Previously, if you talk to the business managers, they are of the view that some time ago businesses could afford the costs in such a way, profitabilities were such that these type of inventory costs, excess inventory, etc., were virtually ignored because the profitability allowed, and the competition and the environment was not as tight and as demanding, and so these kind of costs could be absorbed within the profitability and still provide a reasonable profit to the owners and their stakeholders. With this competition and the environment that we are in these days, the emphasis on cost reduction is quite high. To compete in the market, you have to have your pricing. The pricing has to be based on your cost, and therefore the lower your cost, the smarter your cost, the more efficient your operation, the best price you can offer, and therefore compete well in this globally competitive environment. In the example discussed earlier, we apply the formula method. The result is total cost TC for EOQ of 400 is equal to DO over Q plus QH over 2. This is 40,000 D multiplied by 2 is the cost per order over quantity we calculated as 400. So 40,000 into 2 over 400 plus the Q of 400 into 1 over 2. This is equal to 400, which was the quantity we said is going to give us the lowest cost, or the EOQ. So we have just applied the formula to the information that we used in our first example. In the first example, we had used that the total requirement of quantity for the year is going to be 40,000. We said the holding cost was rupee 1 per unit and the ordering cost was rupees 2 per unit. Now in that example at that time, we had tabulated the results for different order sizes of 200, 400, 600 and 800. And we had seen what would be the total cost. Now, to the same example, if we apply our formula, we can see to prove that our EOQ using the formula gives the same result, we can see what would be the total cost using our ordering cost of 2 per unit and holding cost of 1 per unit with a total demand of 40,000, where the order quantity is 400. If you recall, we had said that the order quantity which gave the minimum cost was the order quantity of 400 units. So if we just insert the figures into our formula for the total cost, we find that the total cost comes to 400, which was the total cost for the minimum, total cost for the order size. So in other words, we get to the same result using our formula. Here we have used the formula for the total cost, which is DO over Q plus QH over 2. That gives you the total cost, and that answer comes to 400. And in our tabulation, we also saw that the total cost, which was minimum, was 400. So we have applied the formula successfully to that data and come to the same conclusion. So therefore, the formula method is going to provide you with this approximation with all its assumption, but nevertheless, it is going to provide usefulness, and we'll see later on how we can use the EOQ as an estimate with having regard to its assumptions and limitations. That's all for this session. Thank you for listening.